Hey everybody, Marty Missouri, good morning. It's the 13th of February 2019. Going to try to keep this one quick, but I thought I should update you on the chart. I also do want to make a point or two about the prospects as I see them for the market as we move further into 2019. But first I want to acknowledge that the market seems to be responding as probabilities would have suggested based on the indicators that have been more bullish as we've moved our way higher versus than these areas here. For example, when we had really three tests of the 200-day moving average. Here we tested it yesterday, closed above it. I can lose this downtrend line here, which is where we actually ran into double resistance here at the 200-day moving average. As I said in last night's blog, we make it through there and then 2800 with some momentum. And then there's not a lot of resistance between 2800 or so and new all-time highs. As I've said right from the get-go, though, it's going to require more than anything else continued good news on trade. Last night the headline was that Chinese President Xi is actually going to meet with the U.S. negotiators this Friday. That was unexpected, and of course that should be viewed with a strong dose of optimism about the prospects for a trade deal coming to fruition. So we're not out of the woods yet. I saw a couple of headlines today that said that, wow, we closed above the 200-day, now it's 2800 and we'll see from there. Well, we closed above the 200-day here, we closed above it here, and we closed above it here. And in each instance, the market failed and ultimately came down to these December 24 lows. Some of the sentimental fuel, if you will, that has driven this market higher is not there to the extent that it was. We had a great deal of bearishness in here among individual investors and investment advisors, essentially folks suffering from the fear of losing. The latest statistic suggests that they're quickly moving to the fear of losing out and bringing money into the market and buying stocks. So those levels of bullishness have gone from very low to average to just above average levels. Certainly not the kind of frothy bullishness we would worry about. We had much, much higher, 60% bullishness among individual investors up in here. Don't quite have that today. One thing we do have, though, is we actually have, according to the Bank of America Merrill Lynch latest mutual fund manager survey, is they are loaded with cash, more so than they have been in the last 10 years or so. Also, my money market asset chart, which was rolling over and coming down as money was coming in here, interestingly, in the last week, it spiked up as well. So there seems to be plenty of fuel out there to rotate in and buy stocks. Short interest, which was extremely high up here, has really fallen down. So we have much lower short interest. It's still a little bit elevated on the S&P 500. So again, what I'm looking for here, folks, is simply evidence that there is room for the market to move higher, and we have to see where the feel for that move is going to come from. It's certainly there. Not as dramatic as it was down here, but certainly there. If we continue to get good news, particularly on the trade front, I think the market has plenty of momentum to move up into these areas and then to new all-time highs. Now, as I've shown you on past charts, I'm going to show you one here in a second. It is highly unusual to get this steep a correction, come out of it, and not come back and test that low a second time. Obviously, that hasn't happened. A lot of people continue even today to call for it. But I'm looking for excuses for it to happen going forward. Clearly, we get the China trade war off the table. That is just a monster headwind that is out of the way for stocks. However, it's still going to be trade, I think, as we move through the year, that is going to potentially be the upsetting factor for the market. The US really seems to want to go hard at Europe. And if we do, I just don't believe the market's going to have much stomach for that. If we get that kind of news, and there could be other things that I'm not thinking about at the moment, a lot of things can happen, of course, in the market. But I think that if we do get a retest of this sometime later in the year, it's basically just jumping from the frying pan of China into the fire of Europe on trade issues. As I said before, let's hope that the negotiators on our side of the ocean, if you will, have really taken note of this and respect that and know that the investor, the consumer, the economy at large may not be able to withstand another big 20% dip in stocks so soon. Basically, here's where I'm going with that. This should look familiar to regular viewers. So this is the S&P 500. This is a roughly 22-year chart. And this is the scores of our PWA macro index. Today it's 86 data points that I score every weekend and have back tested for the last 20 years. So we have 3 periods, this one, and this one back in 98, where we had just about a 20% decline, which is a technical bear market. These were between 19 and 20%. And each time we had macro conditions that suggested a recession was not imminent. We got close here during the European debt crisis, but we didn't get there. And each time when we have this kind of correction, we come storming out of it when those headwinds or those storms abate, if you will. Here's the thing though. Notice retest of the low, retest of the low, even came down, retest of the low, retest of the low, so on and so forth. Not quite here in 2010. There would be your exception. Almost, but didn't quite retest the low in 2010. Not even threatening that in any way, shape, or form. So here's the thing for clients. If we come back and retest that low, that's going to feel really, really ugly. You remember what your December statement looked like. You're going to be wondering, does this mean that the bottom's dropping out and shouldn't we be getting defensive in our allocations? And ultimately, that may be the case. That may be correct. But if it's green, if it remains green like it did here, and all these other green circles, then we're not going to be doing much measurably. Of course, we're always tweaking. As you've noticed, we do tweak sectors on occasion to reflect developments and valuations and other things. But going to a generally defensive posture is going to require a breakdown in general conditions like it did before the real estate bubble burst and before the tech bubble burst. So what I'm saying, folks, is right now things look good, and if we continue with these good headlines, expect more of a move higher. Not that we won't come down, we won't dip below, not that we won't consolidate perhaps right here above the 200-day for a while. That might make some sense to me. But right now the news is coming fast and furious, and as I'll once again suggest, there seems to be enough fuel underpinning the market to push it to substantially higher levels. We'll be talking throughout the year about future developments. Once we get through the China trade war thing, the market's going to be on edge looking for the next potential reason to sell off a bit. Going to be a volatile year, no doubt about it. But right now the setup looks pretty good to me. And I'll continue to keep you up to date. Thank you as always for watching and listening. Talk to you again very soon. Bye-bye.